Hello everyone, welcome today. We are here to give you a tax update today. I'm Ross from Hive and also pleased to welcome Simon Vincent from Hive.
Hello.
You're right there. Well, we had originally kind of planned to give our viewers a little update on the outcomes of the recent budget. So it takes a couple of weeks sometimes for the budget detail to kind of pop out, and we'd had this scheduled, but fair to say, Simon, not a huge amount in it worth talking about. Is it as blunt as that?
Absolutely. The detail actually came out really quickly with this one because there wasn't a lot of it. Next to no announcements on the tax front at all. We did put a little written piece out on budget day, but thankfully they've kept the majority of taxes the same. We didn't get the capital gains tax rise we thought was coming. I still think we will, but it didn't come in this one. We didn't get any talk of inheritance tax changes. There has been a bit of chat about a wholesale reworking of that as well, but no mention this time around.
Great. So we got a stable tax landscape then for the next 6 months, shall we say, at least?
Possibly not quite that long. There'll be a budget coming along again in March, but until then, at least, we should know the world we're playing in.
Great. Okay. Well, you haven't been inactive during this time then, so you've got plenty of projects still going on. What kind of topical tax aspects should people be thinking about at this point in time, or might they want to be thinking about?
Absolutely. I mean, let's make the most of the fact that we know how things are for the next 6 months, 5-6 months. We've been doing a lot of work that I could probably sum up by calling corporate restructuring. Now that sounds really boring, but you know that covers a lot of elements of just changing the way your company is set up, the way your dental practice is run through your company, for a number of different reasons. So we've got clients who, I think probably most people we speak to have had the best 12 or 18 months that they've ever had. They've generated a lot of surplus cash reserves.
Okay.
A lot of people are now thinking about other ways they can invest that without really, people don't want to jeopardize the situation they've got. They don't want to make their future exit more difficult. They don't want to incur excess taxes they shouldn't incur excess taxes by taking those funds from their companies to make personal investments. So a lot of work setting up an investment vehicle that maintains and preserves the cash that has been built up and weaving that into future exit plans. You know, another part of the group restructuring or corporate restructuring is all about getting people ready for their exit, whether it's in 6 months' time or in 5 years' time. There's a lot of planning to be done there.
Can it make much of a difference?
It can make a massive difference, and it will depend on circumstances. But when we're talking about investments, you know, you could lose, depending on the numbers, anywhere between 30 and 40% of what you've accumulated in extracting that from the company. When it comes to an exit, you could be talking about a very real zero tax exit to, you know, an accidental 30% tax exit, and kind of anywhere in between. It's about getting it right for the person, not flicking a switch and doing the set course of action that suits everyone.
I suppose you can see circumstances where people have been accumulating their surpluses, maybe saving them in the company because it's tax efficient to do so. But sometimes there's always consequences to your actions. So if you're accumulating those assets in the company, that it possibly creates a downstream problem at exit. Then is it as simplistic to say?
Yeah. Let's imagine a world where you come to sell your dental practice. You'd love to sell the shares in your company because that's much more tax efficient than any other way of doing it. If those shares also are mixed in with investments, you've got a problem that at that point in time is going to need solving.
Yeah, because your buyer probably won't want to buy.
Well, exactly. And you probably don't want to sell them. You know, if you've got cash tied up in long-term investments, you don't want to, you know, liquidate those now, realize those now, lose out on some gains. Yeah. Weaken your position, complicate your exit.
Okay, but options that you can pull into play?
There's any number of ways around it. If it's kind of planned properly from the start, it's not even a problem when we get there at all.
Good stuff. Okay, well that does make sense. Any other kind of topical projects that you're seeing at this moment?
Well, kind of tied into the similar kind of thing. Once people have accumulated reserves, they've got some investments behind them, they're planning their exit. They're also planning how they pass that to the next generation, without kind of getting a bit grim in any way. People are planning that. The inevitable will happen one day, and the government will take a big slice if things are in the wrong structure. So we're doing a lot of work with people to start to think about that, because it's never too soon to think about that. Shame
to work so hard and then just to kind of throw it all away at the end, whether that's how much is inheritance tax?
40% above, once we get above the limits the laughably low limits that you will exceed just by having a house, 40%.
Okay. So, and can you kind of give what kind of, when you're talking about sort of helping to pass it on to the kids, then is there any kind of themes to that, or? Depends.
Pardon?
It depends, perhaps.
It depends. Always the answer. There's kind of two main vehicles, but again, even within that, there's a right and a wrong, and depending on the numbers we're talking about, and the family we're talking about, and the people we're talking about, a lot of work with trusts to pass wealth to the next generation. A lot of work with what we call family investment companies, or what are called family investment companies. Not something we've invented, but proving very useful for our client base.
Yeah. Okay. So, and generally speaking, with these kind of strategies, then is it a way to enable, tax efficiently kind of pass it on, but probably a lot of practicality a lot of the time as well. The last thing you want to be doing is anything kind of adverse happens, and there's essentially just a lot of admin and heartache to sort out at a time you really don't want to think about it.
Yeah. I mean, essentially, the goal is to get things outside of your estate now. So it's not a task that needs doing at that point in time. And that's all. The admin benefit is almost a side effect of getting the tax benefit. They go hand in hand.
Yeah. Well, quite often, as we're seeing, kind of blending kind of different components together is half the battle these days.
In all areas of tax, you can't look at one thing without looking at the other, because by getting something right, you'll get something else wrong, but without even realizing it.
Well, okay, so some real big kind of aspects, not necessarily going to be impacting everyone's world at the same point in time, but definitely what I'm hearing there is, never too early to start planning exits. If you're dentistry has been a nicely buoyant industry since June last year, when we all figured out that we could actually open dental practices. Okay. Intergenerational planning, building on that kind of wealth accumulation, possibly a few new kind of topics there for people to start thinking about. Anything else going on that you're seeing that people might want to remember? Or
well, the usual. I say the usual. It's very fortunate. Dentistry is a very buoyant market. We're dealing with a lot of practice acquisitions and a practice sales at the moment, as we always are. Particularly practice acquisition work. We've got a methodology to make sure people acquire the practice in the right way. In the same kind of vein as talking about a bit of a corporate restructure, that there is actually a right or wrong way to buy the practice in the first place. So we're doing a lot of work with people to A, make sure they do that, but B, see if we can recover some of the ground they may have lost by having gotten that wrong in the first place before they joined Hive. And that can have huge impact. We can see people lose up to 25% of the value of their loan for buying their practice. Wow. Just by buying it wrong, not even realizing.
So people are getting their tax planning wrong when they're acquiring a practice. So
there's a wrong way to buy a practice, or I should say, there's a right way, and many people don't realize there's a right way. But by not utilizing the correct structure, you can lose 25% of your purchase price in taxes, which is phenomenal.
Are you saying if people have already done it wrong, you can help, or is it a bit of a depends again?
It's probably less of a depends than it is with some other things. Actually, there's in many cases people who have come to us, we have then kind of realized with them that they didn't quite get things right first time round, there is a way to fix it. Now, it may not be fixing it as well as starting right in the first place, but taking an action is always going to be better than taking no action. So it's kind of a free win for people.
Wow. Okay. So if anyone has bought their preps recently, got any kind of niggles that they might have not been as tax efficient as they might have been, that's probably a lot of ways you can help.
Definitely, yeah. Get in touch. We'd love to speak to you.
Yeah, good stuff. On the acquisition side of things as well, I'd remind everyone that we have a dedicated program as well to help people, lift themselves up and perhaps learn some of the things that they don't know when they're looking at running a practice. So yes, we can help with tax planning, but actually also in terms of the success of the business, the marketing channels, all those kind of components as well. So that's a standalone package that we run for people who are, well, to be honest, we think it's always better if if it's before they've acquired, but if you have recently acquired, it's still wholly valuable. And that dovetails hugely with the work that Simon might be doing on the tax planning side of things. Yeah. Well, okay. Brilliant stuff. Still doing crypto tax planning as well?
Lots of crypto, all kind of, as we're kind of is coming out here, this all kind of blends together. So the crypto planning goes hand in hand with the wealth planning. Should you buy crypto? Should you choose to invest in crypto? Then how should you do that? We can definitely help with that.
Brilliant stuff.
People purchasing crypto in the wrong way, in the right way, depending on future plans, depending on what you're doing with it. There's
probably
rights
a whole
and wrongs.
Conversation about altcoins and which are the wrong altcoins to buy and which are the right altcoins to buy.
I'm not going to comment on that. I can tell you on the tax, but I can't tell you what you should or shouldn't be buying.
There we go. I won't ask you for your top altcoin tip then. No, great. Well, that's brilliant. Fast and furious tax update for everyone there, but hopefully hugely helpful. Great stuff. Any parting comments, Simon? Or
still see a lot of people who, particularly associates and practice owners from a number of years who haven't incorporated, and it's a drum I bang, but there's lots of very easy tax savings to be had.
Oh, brilliant. Okay, well, feel free to get in contact. We'll see something whizzing across the screen in a moment. And thank you, everyone, for viewing.
Thank you.